So joining me now to break down the inflation data and, of course, the levels that we see in equities is Mark Newton. He's head of technical strategy at Fundstrat Global Advisors. Mark, great to have you on the show this morning.
Likewise. Thanks, Kristen.
And let's talk about what we see taking shape in the equity market this morning on the back of inflation.
Well, equity futures are mildly higher. That's a good thing, as well as yields have pulled back a bit. The CPI reading at 0.3% was interesting in that it came in as expected, but yet shelter came in much better than expected. Owner's equivalent rent as well as used cars, those are two things that honestly give the Fed a lot of confidence that inflation is continuing to go in the right direction. It also basically solidifies the fact that they will cut 25 basis points next week at the meeting, because those odds have risen now to over 80%. So look, the Fed is on track. The economy, despite a few evidence of weakness on the fringes, is still remarkably robust. And so I think that's the important thing for the Fed to concentrate on, and they still have that leeway to be able to cut.
What else does the data show you about the state of the stock market and the path forward?
Well, look, the market's had an incredible run this year. We're up. We've had the best year in an election year going back over 40 years, so that is remarkable. But what's interesting is that it hasn't been completely all technology driven. There's been a lot of sector rotation that a lot of people have been talking about. And the month of December in particular has been a little trickier after gains of 26% this year. So we started out from July and technology largely went sideways while these other sectors had been showing very good strength. So from my perspective as a technician, it's actually encouraging to see the last 3 months of data where financials, industrials, discretionary, all up more than 10%. That provides a solid breadth backdrop heading into 2025. So, my thinking is the economy, is on pace still. We haven't seen sufficient evidence to think that we're going to have a big downturn. There is some slowdown in hiring, but the bottom line is the wage growth doesn't support the idea of inflation starting to rise. With crude oil continuing to fall, demand issues out of China, the U.S. potentially set to cut energy prices in half with the oil infrastructure, rebuilding U.S. infrastructure. That's going to cause crude to have potentially a big decline on U.S. supply. So those things actually are pretty deflationary heading into next year. That would offset, I think, a lot of the rhetoric regarding potential Trump tariffs causing inflation to skyrocket. If anything, the opposite has happened since the election. Yields have actually fallen. The dollar has fallen, which has been pretty much the opposite of what most have been talking about.
You mentioned that market breadth has been expanding, and I think for many market watchers, that's something they had been waiting for after technology had largely driven a lot of the gains that we saw during the first 2 years of the bull market. Can that breadth continue to expand?
Well, I'm pretty optimistic, at least initially for the first half of next year, based on what's happened in recent months. I think small caps could start to kick into gear. That's been something everybody's watching. We've seen a breakout in the Dow Jones Transportation Average back to new all-time highs. That hasn't happened in 3 years. That should be very encouraging for industrials. So some of these sectors have gotten short-term overbought, but I still think there's reason to be optimistic. Junk bond yields, we're seeing record tights in spreads. That's really important in regards to, signs we want to look for to suggest that things aren't as good. So no evidence of any, issues with the bond market at this time. Sentiment, although it has, to some extent gotten a little more optimistic, is still not at extremes.
How do you look at U.S. stocks versus international equities?
Well, the U.S. is really experiencing this rally of exceptionalism, U.S. exceptionalism, and I think that we've really dramatically widened out the spread between the U.S. And Europe in recent months. It's been one of the largest gaps of outperformance in the U.S. in years, along with really the rest of the world. So at least the rhetoric was that as the president-elect takes control, and that should put some upward pressure on the U.S. dollar, that'll cause flows back into the U.S. And so we've seen the U.S. and particularly the Mag 7, many of these companies have helped our lives for the better in many ways. They're continuing to show very, very good signs of strength, and that's a good thing. So I still favor the U.S. Eventually as the dollar falls, that could support maybe a temporary bounce in emerging markets, but my thinking is that should prove temporary.
Mark, great to get your insight here, especially as we see the stock market on the move today in the wake of that inline inflation report. That's Mark Newton, head of technical strategy at Fundstrat Global Advisors.
Thanks, Chris.